Hello and welcome to today's tutorial on how to trade with the Stochastic Oscillator in TradingView, brought to you by Optimus Futures. The Stochastic Oscillator, often simply referred to as the Stochastics, is a momentum indicator that helps traders spot potential turning points in the market. It measures how the current closing price compares to a range of prices over a specific look-back period. Stochastics are plotted on a scale from 0 to 100, as you can see here in our lower quadrant, where we have the stochastic model plotted for us. When the lines rise above 80, the market may be considered overbought, and when they drop below 20, the market may be considered oversold. These levels don't mean that the market will instantly reverse, because strong trends can keep prices overbought or oversold for long stretches. Instead, think of these as zones where potential momentum change can occur. Now, let's look at the blue line, which we're going to call the percent %K. This is the main line, and it shows where the current close sits relative to the high-low range for the past number of bars it's selected, usually defaulting to 14. In this blue line, we can see how it looks, and we can follow along and notice how when the bars close up and up and up in multiple green candles, the percent %K line starts to move upward. And as the candlesticks start closing lower, as they did here, you can see it drop precipitously down even below 20 in a very short period. The second line that we have available to us is called the percent %D, and here it's shown in orange. The percent %D is simply a simple moving average that helps smooth out the noise and helps us act as a signal for potential trade opportunities, similar to what you might see with the MACD crossover. Now, one of the ways that we can use it is similar to the MACD, where we look for crossovers between the percent %K and the percent %D. So in this case, we might see a bullish crossover where the percent %K drives over the percent %D, as we see here, leading to a potential reversal in price and moving higher, as shown here. Conversely, we can see where percent %K drops below the percent %D, as we see here, and this signals a potential reversal of bearishness, which ultimately we did start to see, and we saw the ES futures start to drop through over the next several bars. Now, you can look for divergences between the asset, the underlying price itself, and the stochastic model to signal potential reversals as well. For example, if we zoom in over here, we can see that price started to make a second bottom here with a lower low here, but you will note that the low here in the stochastic model and here are about the same, and yet in the price for the ES futures, it's a lower lower. So that is a divergence between what the stochastic model is showing and what price action is showing. That signals a potential reversal combined with a crossover here, and you get a bullish reversal moving to the upside. Now, conversely, we can see here where the price held pretty much the same price over three separate highs. And yet, over that same period, we began to see the stochastic model make a series of lower highs. In fact, here being a particular one where the lower high occurred. That ended up driving momentum lower and signaling a potential short opportunity for a bearish reversal. Now, you can also use stochastics to confirm trend conditions. In an uptrend, stochastics may often sit above the midpoint, which is right here in the middle. And in a downtrend, they may often sit below the midpoint, which is you might see down here. Now, stochastics can work on any time frame, whether it's the daily, weekly, or even the intraday. Many futures traders will layer stochastic models on top of one another to get signals and align multiple time frames so that they can get stacked stochastic models. Now, you can add the stochastic indicator by simply clicking on the indicators at the top and typing in stochastics and adding it here as we've done. And then you have some options to choose from as far as setting up your stochastic model. In this case, we've set up our stochastic model with percent %K having 14, the percent smoothing on 1, and the percent %D smoothing as 5. Typically, you'll see these default to 3 and 3. And you'll notice that there's a slight change when we do that. Now, if we get rid of those and we add the percent %D smoothing and we up that to even higher, so let's say we go with 10, you're going to see that the orange line starts to become even smoother. The lower the number that you use for these, the more erratic you're going to see things on the chart. So as we notice, when we took this down to a 2, this will add more ups and downs that we see in the %K line. So that's something to consider. Shorter settings may give you more response, but they tend to be choppier and give you some false signals. Well, longer settings can smooth things out, but they can react a little bit slower. Well, that's it for today's video on trading with stochastics and TradingView. And remember, there's substantial risk of loss in futures trading. Past performance is not indicative of future results. Please trade only with risk capital. Thanks for watching, and we'll see you all in our next tutorial video.